Hello, everyone. Thanks for joining us today on our webinar, Financial Modeling for SaaS Founders. I'm your moderator, Brian Parks. Today, we're going to have a look at Christoph Janz's SaaS Financial Plan 2.0, which is a great template to build off of for early and growth stage SaaS businesses. So I want to start off with a little bit of housekeeping, go into some introductions, and then we can go ahead and dive into the model. We've got a decent amount of content to cover. So we're shooting for a 40-minute presentation with 20 minutes of Q&A at the end. Should you have any questions along the way, feel free to enter them into the chat window, and we'll do our best to get to them in the Q&A or even in the interim of the presentation if we're able to. After the presentation, we'll shoot you a copy of the deck and the webinar video as well. So if you miss anything, you'll have it at your fingertips here post-webinar. All right, with that, we've got a really good crew with us here today. Obviously, it's Christoph's model that we're reviewing, and we've brought along Matt Talbot and Nick Franklin, two of Point 9 Capital's portfolio company CEOs. So with that, we'll just do a quick round of introductions. Christoph, if you want to kick us off.
Sure. Well, thanks, Brian, and hello, everybody. I'm Christoph Janz. I'm one of the partners at Point 9 Capital. We're an early-stage venture capital fund based in Berlin with a very strong focus on SaaS. And I also run a blog called The Angel VC at theangelvc.net, which some of you might have heard about.
Awesome. Thanks, Christoph. Matt?
Great. Yeah. Hi, everyone. I'm Matt Talbot. I am co-founder and CEO of GoSpotCheck. As Brian mentioned, we're a Point 9 portfolio company. So we raised our Series A last summer. So we're kind of between that Series A and Series B stage, based in Denver at about 70 employees now.
All right. Thanks, Matt. Nick?
Hi, everyone. So my name's Nick Franklin. I'm the founder CEO of a company called ChartMogul. We do business intelligence software, analytics software for subscription businesses, SaaS and subscription businesses. And we are pre-Series A. We've actually done a seed round and a seed extension round. So we're in that kind of pre-Series A stage.
Okay, great. Thanks, guys. And I'm Brian Parks with P2B Investor, based in Denver. We are a crowd lending platform providing commercial lines of credit. I focus exclusively on working with technology businesses, primarily utilizing a SaaS model to provide them with debt capital. And owe these guys a lot of many thank yous. Christoph, Nick, it's late in your part of the world, so thanks for staying up. And Matt, thanks for hosting us.
Sure.
Pleasure.
So we're here today really to, I think all of us on the line share the purpose of helping you as a SaaS founder have a tool that you can understand, evolve, and customize, and hopefully call upon as you're growing your business in order to plan, communicate, make decisions. So our tool of choice, as we've mentioned, is Christoph's SaaS Financial Plan 2.0. So with that, let's hop into it and learn how to master it. So as we can see here, Christoph's model is really popular kind of in the SaaS community. He's done an awesome job of open sourcing not only this, but a few other tools that I certainly have called upon. So got a great endorsement here from Jason Limkin saying use it, which I wholeheartedly agree with. So Christoph, I'd like to throw that to you, and how do I use this, and who am I that should be using this model?
Sure. Well, I guess on the how to use it part, we'll dive in some depth over the course of this webinar. In very general terms, I view this template as a starting point. It's for sure not a turnkey financial plan for your particular business, because I think this just doesn't exist. It cannot exist because every business is different and unique. So you can only use it as a starting point, which will hopefully help you or other SaaS founders to think through your own model and then make the appropriate adjustments. I think in general, the model can work well for SaaS founders at the seed and maybe Series A and maybe Series B level. Also, maybe worthwhile to point out that this is as you said, this is the version 2 of this model, and there was a previous version of it, not surprisingly called version 1, which I created several years ago, which was a bit less sophisticated, and which might be the better choice actually for a seed stage SaaS company, primarily one that is selling to SMBs and doesn't really need the sales team hiring build up of the 2.0 version, which I think we'll also talk a bit about a bit later on. Whereas the 2.0 version I think is more suitable either if you're selling to enterprises, or at least if selling to enterprises is part of your business, or if you're a slightly later stage, like let's say you are a Series A company and you're working on the plan for the next 12 to 18 months or so as you target your path towards a Series B.
Okay, great. Thanks for providing that context.
Sure.
Yeah, no, I think it picks up the word shown here on product hunt, customizable, and it's one of the things I really like about the model is it doesn't view itself to be an end-all be-all, must fit within this. It's a framework, it's a template, something that as a founder hopefully you can use to customize to your business. So brings us to the next slide. These are personally things I love about this model and why I think it's such a great tool. It's pretty simple, right? So it does a nice job of kind of balancing bottom-up builds that can get complex with really not getting that complex within the construct of the model. Kind of got 3 schedules primarily that drive the model, which we'll touch on over the course of the webinar, and then some nice reporting in the form of a summary dashboard and some charting. So within those builds, I think Christoph's done a great job of keeping kind of intuitive driver patterns. So if you think like this, view it as a piece of software, right? So I think it's nice and replicable, easy to maintain, adjust, and it's transferable both with the comments and the driver pattern. So I just think it's a great tool and excited to jump into it and chat about it with everyone. So
sounds good.
There's a link to the model. We're not going to live demo the model. I kind of wish we could, but I think it'd get a little bit too crazy. So we'll have some screenshots of it. If you want to take the model from Dropbox, it's out there at that link. All right, so as I mentioned, there's 3 primary schedules of this model. Those are the revenues, costs, and there's a sales team hiring plan, which Christoph mentioned was in addition to V2 of the model. So starting with the revenues, really what's going on here is building your customer base and your associated MRR by segment, while also detailing the components of your MRR. So it's the most complex build of the model, and probably where we'll spend the majority of our time. Without going too heavily into the details on this slide, as you can see, there's kind of 6 primary driver categories that really drive this schedule. So sitting at the top of the revenues worksheet is the sign up section. It's really the lead delivery mechanism for 2 of our 3 pricing plans. So Christoph, I'd like to just turn it over to you there and kind of ask, what role does this section play in the model? Kind of what's going on here? What's the basic idea?
Yeah, sure. As you said, I try to keep it pretty simple for a couple of reasons, and one of them is first one is maybe just to keep it manageable, and the second one to still keep it generalizable. So rather than making a lot of assumptions about what could be specifically the sources of signups or customers, I kept it pretty simple here, because whatever assumptions I can come up with, they'll probably be wrong for 90% of the readers looking at this. This is why I kept it really simple and worked with only 2 primary categories of signups. One being organic, which basically just means signups or trial accounts that you're not paying any advertising dollars for. And then secondly, the opposite of this, which is signups that you're paying money for through some variety of online spending. And those really are the two drivers for the amount of signups that you're getting each month according to this model. You can see on the left side in blue the various numbers and assumptions that are made, and all of them can obviously be changed. They are really just placeholders. So you can fill them in with either your best assumptions, or even better, if you already have some data, your assumptions based on the data that you have. And then the logic is pretty simple. You add a certain number of new signups organically and a certain number of signups due to your marketing spending every month, and this sign-up volume then converts into paying customers at a certain conversion rate, which you can change here. Then what I've also modeled here is a small conversion rate of older signups, which basically just means that while most of your customers might in this model have a very short sales cycle of, let's say, just on average a month, you are obviously also building up a base of signups that do not convert within that short window of time, but you might still have a chance to work on them and eventually convert some of them. And this is what I've included here in the model with a very small percentage rate, but you can obviously adjust that as you see fit. And then there is an assumption for a churn rate and for your ARPU or ARPA, which is the average revenue per user or average revenue per account or per customer, however you may want to call it, per month. And if you basically take all of this together using pretty simple math, you get to the MRR that you're getting from this segment of customers.
Okay, great, awesome. That kind of took us right into the next section of this worksheet. Actually, we skipped a section. We're going to skip the basic plan and just go straight to the pro plan. They function very similarly, except the pro plan has a few kind of more movements in and out of the plan in the form of upgrades and downgrades. So Nick, if you can kind of walk us through what's going on here as you're building this customer segment and the associated MRR and really the components of MRR. Yeah. What are these acronyms we're seeing on this slide? Christoph just touched on them, and kind of how do we use them?
Sure. Yes. So the idea behind the pro plan is kind of a premium self-service plan. So it's kind of what would follow from the previous slides talking about the number of signups, and then that would lead into a certain number of pro plan paying customers after that, basically. The acronyms like ARPA is short for average revenue per account, or average revenue per customer, which doesn't make a very good acronym. And it's really, in this, it's really meaning the average revenue in MRR per customer, and kind of normalizing everything into monthly revenue. And MRR, of course, means monthly recurring revenue, basically just your revenues normalized into months, your subscription revenue normalized into months. And the other acronyms are CAC, customer acquisition cost, we see there, and MM grow, month over month grows, and these kind of things. But then to kind of drill a bit more into MRR, and what's happening here is it's kind of saying, okay, well, there's net expansion MRR, and then lost MRR from churn and downgrades to basic, which is often called contraction. So it's modeling out fluctuations in MRR from anything that might raise it. This might be like an upgrade or adding additional licenses, and then anything that might reduce the MRR. So here we have theoretical downgrade to the basic plan, or churn or something like this, falling in and out of this plan. So this is really kind of like how we model our business for the most part, and the previous slides around signups is kind of how we think about our business. I think the only thing one of the main things we perhaps do differently rather than raw signups is kind of qualify the leads and, say what is the number of qualified leads and those conversion rates versus just the raw signups. And then, so I think, I think that's the basic gist. It's really just showing how many customers are coming in, how many are falling out due to churn, and then the various movements in terms of upgrades and downgrades, and how much MRR they're contributing based on the average revenue per account, which is slowly increasing. And there's one sort of the thing with average revenue per account is it kind of takes all the active subscribers in that month and averages the MRR across those subscribers, which maybe is kind of taking a large historical base of subscribers. So often it's good to look at the average sale price in MRR, which is just for that month. And so if you like increase your price dramatically, for example, you're not going to see that impacted in this model immediately, because it will take some time before the averages move up. So it's often good to kind of work ASP, or average sale price, into the model as well, especially if you are playing with pricing and things like that.
Interesting. And then is there, in terms of working ASP into the model, is that something that could fit easily within the construct of this model? We kind of see we've got the ARPA increase on a monthly basis that we can play with. Is there?
That's another way to do it, is just to increase the ARPA. I mean, you would hope that would slowly increase as your existing base expands or upgrades. And if you do raise prices, this is just from a recent experience that we had where we recently removed our starter plan, where we had a $9 plan. So our ASP jumped dramatically from one month to the other, whereas the ARPA takes some time to move. In terms of working it into this model, I won't talk to that right now live.
Yeah.
But,
Christoph here chiming in briefly. I think it's a good idea, actually, and I would have to look into it, but it can probably be done with just a few extra lines. I guess it's one of the many compromises that I made, like trying to balance it between being powerful on the one end and simple on the other hand. But I think it's definitely worth considering for the next version to model this a bit more granular, so that you can see, as Nick pointed out, the more immediately the impact of a price increase before it really becomes visible in your average pricing across the entire customer base.
Right.
Yeah, and I kind of say, the big thing here more than anything, right, with the good models to help you think about what is unique about your business, and how do you work that into some sort of model. So to Nick's point, right, they made some changes on pricing, then that becomes an instrumental driver to the model. So now ASP is very important. And I think that's really what, a very good simple model exposes, is what are the things that are kind of outside of, a standard model or outside of the norm that we're doing that's different. And that helps you, force a little bit more discipline in your thinking to understand what are the drivers in my specific model for my specific business. Early on, I think it's very wise to be experimenting with price in any number of different ways. And I think you just need to think about, what is the driver there, right? Is that dropping certain plans and launching new plans? Is it trying to increase, the average number of users that sign up per account? There's a number of different ways to do that. And I think that, kind of to the benefit of a simple model is that it helps you kind of expose some of those unique circumstances. And you can take something like this that's really kind of the Lego map that you want to build the model on top of, and begin customizing it per your exact needs.
That's great. I guess one thing that jumped out to me that I hadn't asked you, Christoph, or Matt or Nick, we're looking here in this screenshot at January 2016. We're seeing a quarter. Obviously, we're sitting now in August 2016. What would be your recommendation for someone picking up this model? Is it, backfill it with history? Is it just change Jan to August and roll it forward 24 months?
I'd probably roll it forwards. Personally.
Yeah, I think it's as you build models and then you get in the notion of even budget versus actual or going to that level of detail, things can get messy. So I guess I'm interested in a separation of concerns of, is that beyond the scope of this model, and this is your 24-month forecast model, which I think it is.
I would say generally for us, like we're at Go Spot Check, we're really, really concerned with kind of budget versus actuals. It's something we look at all the time. The most important thing is that you kind of develop your own cadence for what that looks like at your company. The way we do it is we set, an annual business plan, and that becomes, our kind of BP forecast. And then we update that formally, usually twice a year in April and September. We're always going back and kind of running the difference versus the original plan versus the April update versus the September update. The biggest reason why, you kind of want that BP to be locked, and say, this was our best guess when we started the year, right? This is really what we thought we would do. And then as you assess, usually in a separate model that you're kind of running a comparison against, you can see which assumptions were off, right? Maybe it was ARPA that was off. Maybe it was the number of customers. Maybe your churn rate was much higher than you expected. The important thing to remember is that what you model will be wrong. The important thing is to understand what is wrong about your model, right? Yep. And when you have a very clear model like this, you should hopefully be able to tie back and go, okay, I see the problem was that, we were forecasting, maybe we got the exact number of customers we had thought, but the ARPA was 30% lower than we thought it would be. Okay, so there's an issue. Why did that happen? Well, too many people stayed in the basic plan and didn't upgrade. Okay, maybe that means customer success needs to work a little bit more on driving upgrades. Mm-hmm. And then that gives you a very actionable set of things that you can take to your team to improve that performance. So, I think that the general framework is use this to set your kind of business plan, maybe your updates throughout the year, lock it down, and then go back and have the discipline to compare against what you thought would happen. We do that monthly, like I said, to do that comparison. And I think that's, really, really essential to kind of managing the business towards your goals.
Excellent. Thanks for that, Matt. Well, since you just did such a great job of explaining that, how about we throw the next slide to you? So I know here at GoSpot, you guys, you're selling to enterprises. Enterprise sale, direct sale. You've built a customer success organization to support this direct sale and kind of grow those accounts. Yeah. So this plan right here differs substantially from kind of the inbound model with the basic and pro plans.
Yep.
Can you walk us through what's going on here?
Yeah, definitely. And I see that there are a couple of questions that relate to this that I can kind of touch on that look like there might be some SaaS founders that have similar models to GoSpotCheck has. So hopefully this is helpful. A couple of things before I jump into this slide is, back to kind of the signups view. We don't convert people. There's no self-service at GoSpotCheck, right? So everything's behind talking to a sales representative. So we're really trying to convert people on our website to request a demo. So with that said, the signups view is still extremely helpful. It's just instead of signing up and converting right away, we're looking for demos. And I think it really is important to understand that part of the model, whether you're self-service or pure enterprise, because that's going to give you a huge indicator on how much traffic do we really need to drive, how many conversions do we need, ultimately how many of those folks turn into customers. One of the trickier parts with an enterprise model is that sales cycle time tends to be quite long. Depending on your kind of ACV, in this model, it's built to 60K. 60K deals, I think you can probably anticipate somewhere between 2 to 4 months to close. Certainly, you'll have ones that are faster than that, ones that are slower. But generally, you have to understand that ramp and that sales cycle time. So connecting that requested demo all the way to dollars in your model is something that you should constantly be pressure testing, and measuring against your initial forecast. Because that's certainly one way where you can get tripped up, is assume that as soon as someone requests a demo, within that same month, they become a 60K customer, or even within the next month, they become a 60K customer. I would highly advise, if you're in this dollar range, call it, 50 to 75K or so, I'd probably go with a 3 to 4 month sales cycle. And if you end up outperforming that, fantastic. If it ends up being a little bit longer, at least you're on the more conservative side to start. So in thinking about enterprise plan, right, the big thing is that you're really paying attention to the two kind of key drivers that Christoph has here in the model, which is what's the size of your average contract and how many customers are you going to add per month. The way that we do it here is we vision ourselves into the future with our business plan and say, where do we want to end the year, right? What's the type of growth rate that we believe we can drive? If you're, depending on the stage you're at, obviously you're going to try to shoot for something between 7.5% and 20% month over month growth. The earlier you are, the steeper you should be on that curve. And Christoph, I think, actually has a great blog post about kind of the decay of month over month growth rate. So that's something really important to keep in mind too. But the real driver here, right, is you're looking for that average customer size, and then you're backing into the amount that you need to add each month, which is essentially going to be new customers at that specified ACV. So looking at this, you're really saying, okay, our goal is to grow X amount per month. That means that we need to close X number of these new customers, let's say in this model, 2 new customers, and we're going to lose 1, in this case, in January. From that, you kind of have your revenue target, and that's very, very helpful. I think understanding that balance between upgrades on renewals and then mid-cycle upsells and expansions is really tricky. But this model supports that pretty well with that 10% price increase upon annual renewal. I think what you have to look out for is, can you drive expansion and higher dollars throughout the course of the first year of the contract? Should be, of course, a goal of yours. So as soon as you've landed on that MRR growth target, you're going to go through the process of understanding what does the sales team need to look like in order to hit those targets. We will touch on costs, I believe, very briefly at the end. But one of the things that we've learned over the years is assume it'll take a lot longer for those sales reps, those AEs to ramp than you think. It just typically does take a while. But if you have some reasonable benchmark on an attainable quota and you have a goal in terms of MRR to add, it really just becomes kind of a math problem more than anything. What you want to look out for is if you say, hey, we're going to grow 20% month over month, and that means in 6 months we're going to be at 500K MRR, that means you're probably going to need a lot of AEs, and it means they probably need to be hired very, very soon. So you always want to kind of sanity check, where does this put us at the end of the year, and what does that mean in terms of hiring? And then does your bank account support that, right? That's the big thing, because during that period that they're ramping up, it's very, very, very costly to the business to take on that expense that's not productive yet. So you need to kind of constantly balance those things. And I think that's ultimately the way to get to a good enterprise model. Let me actually add another couple of things here. So one of the questions kind of came up on modeling churn, which is super important to our model. If you're looking at kind of a more enterprise model, you kind of need to assume that you're going to see a very, very, very negative net churn, meaning your customers are growing with you along the way. Because that's kind of the beauty of selling into the enterprise. You land with 1 team, you expand to 2 teams, you add some additional products or services on top of the contract. And so you want to, as quickly as possible, get to some sort of assumption on what you think you can do in terms of net churn. And then on top of that, gross churn, who's actually going to leave. I think that this is, a really, really tricky thing to model. If we look back to what we've modeled in the past, we've tended to underestimate gross churn, the number of kind of logos that will leave, which is still very few in our world, but it was a little bit more of a gross churn than we expected. And then we dramatically underestimated how much growth we would see in current accounts. So I think that, that's the tricky thing. I would highly encourage any founders out there to do some benchmarking, make some phone calls, understand, from folks like me or other folks that are maybe a couple years ahead of you, what have the actual numbers shown? Folks like Christoph and Jason Lumpkin have been amazing at providing content to help with that. But you kind of want to come up with a best case benchmark And then have, a couple scenarios around that. What if you're a little bit higher? What if you're a little bit lower? How much risk can you accept against that? And what can your bank account support? And then ultimately, I think you'll end up with a pretty reasonable estimate for where you should be from a churn basis.
Yep, great. Thanks for that, Matt. And one thing to note too that Matt kind of touched on, as you're modeling and tweaking your model at the component level, these drivers are sensitive, right? So you'll probably notice as you change a 0.5%, 1%, you may see large fluctuations in the results. So we're not going to go into it here, but encourage folks to do some sensitivity analysis and to really understand the impacts of moving those levers across the business. So.
Yeah, I think the most important thing probably, and this model is fantastic at helping that, is understanding that ripple effect. That's the challenging thing. It's in these types of compounding businesses. Like I mentioned earlier on MRR growth rate, it's pretty unwise to just go, hey, we're going to hit 12.5% month over month for the next 2 years. Like that probably won't happen unless you're Slack. You're probably going to need to assume some reasonable growth decay. That's kind of grounded in how quickly you can hire and ramp up account executives and how well you can upsell via the CSMs. But there really are, kind of a few core things where, if you're off in that assumption, that can have like a disastrous impact on, your cash needs and what the business looks like. So more than anything, I think you want to kind of pay attention to those things in your model where if it swings a little bit one way or another, you end up in trouble. Right, because that becomes as founders, that's the risks. Those are the risks you really need to pay attention to as you begin to operate and scale up your business.
Yeah, that's a great point, Matt. And actually, I obviously see lots and lots of financial plans by the nature of my job, and many of them aren't that great, which of course was also one of the reasons why I built this one. But really a pretty classical example I would say mistake is that you build a plan and you just assume that you're going to grow 20% month over month, and you do this for 2 or 3 years, and then basically world domination is very close. But if I see such a plan like this and it's not backed up by anything, like by heavy investments into marketing or by a sales team hiring plan, then it just tells me that the founders just haven't thought through it carefully. Or maybe, it doesn't mean that I won't talk to them, doesn't mean that we wouldn't consider an investment, but it just tells me that it's not going to happen like this. It just doesn't. Maybe it happened in the case of Slack, but that's an absolutely unique outlier. That's not the kind of strategy that you can build your business on.
Yeah, totally. I do think there's some model out there that's, I think it might have been from Scale Venture Partners, and Christoph, you might be familiar with it. They have a growth decay model that basically starts with your year 1 growth rate and then begins to decay down to ending in year 5 at a 30% growth rate, which tends to be I think based on some benchmarks, a pretty common curve. And they kind of have a high road, middle road, low road in terms of growth decay. If you have any early indicators, right, you want to be paying attention to that growth curve. How quickly is it shooting down, or is it staying consistent? That will be a really good way to get a sanity check on, year 1 to year 2 year-over-year growth, year 2 to year 3 year-over-year growth, and help you kind of get into something that's a lot more reasonable. It's easy to kind of, to your point, Christoph, drag that formula out, all the way to the end of year 3 in your model and look great to your VC and, really, really convince them. But any savvy investor like Christoph will immediately look at that and go, listen, that's just not supportable for a host of reasons. You're going to have 150 salespeople and you're hiring, 40 a month or whatever in the last 3 months. It just doesn't quite make sense in terms of what the organization can handle.
Yep.
And, there are benchmarks, right? There's some physics in terms of the way that these types of businesses scale and what's to be expected. And, this is one of those great opportunities, like everyone on the call is doing today, learn from the people that have done it before, find your benchmarks, and then build your assumptions off that. You can make the call if you're going to be a middle road, low road, or high road in your performance, and then try to hold to that, but at least have some sensitivity to the fact that there's a pretty broad spectrum of what can happen.
Yep, absolutely. So thanks, guys. Sanity check it. It's easy to get lost in these models after you spend hours and hours and hours with them and iterate on them. So a good sanity check is always a good thing to have.
We totally did that in our first year of business. Is just drag the flat percentage growth rate out for the year, and then realized halfway through the year that we should definitely revise this as it kind of exponentially becomes less realistic. So that was the rookie mistake we did.
It happens to the best of us, Nick.
So I've learned now.
All right, great. Kind of as we thought, we spent a good amount of time on the revenue section of the model, but it's extremely important. There's a lot going on here. And to Christoph's credit, right, he's kept it nice and simple, but there's a decent amount under the hood. So thanks for walking us through that, guys. Nick, do you want to touch on this MRR movements graph here? Actually, I may just come back to it and jump into the costs, and I want to make sure we can touch on the sales team hiring plan. So we can revisit this after we come through those two sections.
Sure.
The cost worksheet within this model is, it's pretty simplified. I think we'd all recognize that. It does its job well of helping you think about your costs thoughtfully, but it's not going to go, overboard and, down to the level of what you're paying for your stamps every month. So I think it strikes a nice balance. It's really got three sections that we can touch on really quickly. Two of whom are related to your people. So you've got your salaries section, and then your other staff related costs. And then really the third section is modeling your OpEx and to some degree CapEx, although it's not technically CapEx in the business as well. So jumping into to the headcount now, this is kind of fixed headcount, so to speak. This is G&A, engineering, R&D. Does not cover your sales team or your customer success team fully, as those need to kind of scale with your revenue. So Christoph, do you want to kind of touch on what's going on here really quickly?
Yeah, sure. There's, I guess, most of this is pretty self-explanatory. So you can basically build your hiring plan here. Think about who do you want to hire over the course of the next year or the year afterwards? How much do you think you have to pay them? When do they start? What's the bonus? Then you have a section for where you can enter what you have to pay in terms of payroll taxes, benefits, or related cost items. Then you can, if you I'm looking at the actual model now, which you obviously can all download on your machines as well. If you go a bit further down, there are some headcount related costs such as traveling, office costs, hard computer desk, all these things which are more or less a function of your headcount. So they are closely tied to that, and the model reflects that. And then there is another category which I've just called various, which consists of things like payment, server infrastructure, marketing spendings, office rent, recruiters, and a few other things. And then there is even an other costs line item below various, which really just serves to catch everything that I have forgotten, or which you as a founder don't really specifically think about, but you just know that in any given month there are some of these cost items that you just can't predict. So I think it's always good to have some buffer for that. Maybe one comment maybe on the marketing spend. To keep it simple, I have it here under various in this bucket. I think you may want to think about adding a couple of details here, maybe turning it into a section of its own, and maybe adding some more detail and including like your major customer acquisition channels as separate line items. Again, one of the many simplifications that I did here, but I think it's fairly easy for somebody using the model to adjust it to his or her needs.
I think that's great. I'll kind of chime in from a couple thoughts on costs. What we found is that, I think Christoph kind of nailed it. Like, more or less 70% of your expenses are going to be people and people related. The next biggest chunk is going to be marketing spend. Other than that, a lot's like kind of important to keep an eye on, but I wouldn't, fall into the kind of depth of getting into every detail there. Keep a very small slush fund like Christoph has here as kind of your other costs and things that pop up, during the course of running your business. The biggest thing as soon as you kind of run that budget versus actual and understand, what's actually happening in the business versus what you planned, the way to kind of make that up is going to be by either pushing headcount back and hiring people later, or if you're doing better than you perform, pulling it up and hiring more aggressively. That's really what's going to be like the huge cost driver, I think, more than anything. And it's a thing you just have to be really careful with. It's easy to get into like kind of a hiring spiral and lose kind of your attention towards what did you actually forecast from like a net income or cash out the door perspective. You always want to kind of, the story that you're going to be telling your investors is going to be about revenue growth. The important thing as an entrepreneur is to keep your eye on kind of cash balance and net income. At the end of the day, right, the less profitable you are as you scale your business, the more capital you need, the more dilutive it is. And any great investor is going to be aligned with a capital efficient plan because it allows them to not get diluted more and more as more capital is raised, right? So those are important things to keep in mind. I mean, it's certainly always a balance, but as you begin operating and really scaling the business, like headcount is the thing to really, really watch out for. And that requires a lot of discipline, especially in the early stage, because we all know that we could all use more hires at any given time who could come in and have a great impact on the business. However, it doesn't mean that you should actually go about that, right? Delaying hires a month, 2 months, 3 months can have a massive impact 12 months from now on what your cash balance is. So I think that's just a really important thing to keep in mind as you're actually going from the plan and moving into the managing your business side.
Yep, absolutely. Okay, let's cover really quickly kind of the sales team hiring plan. Christoph, can you walk us through this? This is obviously part of V2. It's really driven by kind of you've got your ARR target, you've got quota set, you're ramping your AEs, your account executives. And then you've got some folks that are supporting the sales development efforts. If we just jump to the next slide, if there's any kind of salient points to share here, I think it's a great schedule.
Yeah. Okay, sure. I think this is probably the least intuitive part of the model, where everybody who wants to use it will probably have to spend a little bit of time really going through the logic. And if anybody finds a way to improve it and make it simpler or more intuitive, I'm all ears. The way I build it is that on the revenue tab, actually you enter your goals, like where do you want to end up in terms of MRR or ARR, let's say at the end of the year, and then end of year 1 or end of year 2. And then it's basically goes backwards from that. It calculates like how much new MRR do you have to add in any given month based on all the variables that go into the model. And then it calculates how many salespeople do you need based on your assumptions, how much quota each salesperson or AE, account executive, as it's called here, can carry. It takes into account that when you hire a new salesperson, they obviously are never fully effective from day one. It typically takes a couple of months to ramp them up, and this is also one of the inputs to the model here. So in this with a sample example numbers that I've used, I was assuming that in the first month they only get to 25% of their quota, and then in month 2 it's 50, and month 3 it's 75, and then starting from month 4 they hit their full quota. And you can obviously play around with all of these numbers, and then I've also assumed in this model that there are some, let's call them supporting roles that you need to have in order to make your AEs effective, such as sales directors, because your VP of sales probably can't directly manage 50 salespersons. It's just not doable. So you need some hierarchies at some point, and otherwise the whoever runs the sales team just has too many direct people to interact with directly. And then another assumption here is that you need some SDRs or sales development reps to help your AEs basically get enough leads. I think those are like the major inputs and assumptions that go into this model. And as Matt mentioned previously, it's pretty interesting if you run this math, because it can have, I think, when you really do the math, it can have again also maybe unintuitive results. And I think in this case, it's actually good if you are forced to not only trust your intuition, but really look at the numbers, because you may actually find out that you need to hire many more salespeople, or that you need to start much sooner to hire salespeople than you think. And that obviously means you have to spend more money earlier than you might have expected. And so if that is the result of the model, then it forces you to think about it and maybe change something. But it's obviously better if you find this out early while you're still in the planning phase and while you can still make changes, rather than finding it out too late when either you've run out of money or maybe you've completely missed your plan.
Yeah, that's 100% right. I mean, we found that I think that certainly there's a very strong relationship between deal size and ramp up time. In theory, the bigger the deal, the more complex the sale is, the longer it takes to learn the customer personas and the product in order to get productive. Yeah. That was one of the mistakes that we made. And Christoph's aware of this. It's very helpful, is that we kind of came in and said, hey, they're going to ramp pretty quickly. That ended up taking longer. And we have a large deal size, so that should be expected. But I think, to Christoph's point, right, really think critically around, what is the complexity of the sale? How big is the deal? And then, base your ramp up time on that. And also, of course, for kind of like your first batch of AEs, the biggest thing is going to be, transitioning from kind of primarily founder driven selling to, hired gun selling is also kind of a rocky period. So to a large extent, if you have big goals, get started sooner, get a couple people in, hire a batch of 2 or 3 or 4 AEs, begin training them, and then see what happens in terms of ramp up time. Probably the biggest mistake you could make while scaling is hiring too many AEs without really a clear idea of what scaling looks like and how long it'll take. Just because that, carrying cost is quite high for that team. So
I think that's a good. Sorry, go ahead, Nick.
I was just going to say there's a good question in the chat just now, which is maybe relevant to this slide, around international growth and how the model might change for, where, revenues are lower per customer and the costs are also lower per AE. And I think the model here can still be used almost directly, but you can just, you just have a lower quota and per rep and hire more reps. And my previous role before starting this company, I was a sales director in Asia and managing inside sales reps and SDRs and this kind of thing, and mostly selling into Southeast and Northeast Asia. And we had a similar model, but yeah, the quotas, we had more people and the quotas were lower too. Basically, we had just adapted the strategy for the local market. So that would be my answer to that question.
That's great. Thanks for sharing that. And another question was kind of, and Matt kind of just touched on this, it's not a great thing maybe if you hire way too many AEs out of the gates or as you're progressing along. So, one of the participants said, hey, we thought quota was 50K a month, but we're experiencing 175K per month. And kind of, what the model doesn't necessarily contemplate in its current form is say an increase in quota. So it's got the ramp, but it doesn't assume necessarily that your salespeople are being more effective at selling. It can carry a larger quota. So to kind of address that, I think you could do it a couple of ways. You could model it out monthly, or you could just, you could hard code the increased quota in. You could, I think it's an important factor to consider.
Yeah, definitely. I mean, I think if you're finding that, your AEs are way ahead of quota, like that's awesome.
Yeah.
Like that's champagne problem, scale up, call Christoph, he'll be stoked.
Fantastic problem to have.
Yeah, that's
absolutely.
That's a great problem. Unfortunately, most of us deal with the other end of it, which is that, there's only some percentage of reps that are truly productive, and you're really trying to coach and figure out if the other ones have a shot to get there. So yeah, to Brian's point, I think you nailed it, right? Kind of adjust what that true quota is. We've tried to, at a pretty good cadence, increase quota over the years. I think early on, set your expectations relatively low on what people will hit. And then, if you feel like the opportunity is there, if you see some people begin to outperform, ratchet it up a little bit, right? Create a bigger challenge. There are certainly some human sides to this, right? There's people that are outperforming quota and maybe getting additional bonus. You don't want to screw them over and go, guess what? We just moved the bar a little higher. So, that impacts maybe your total comp. You have to think very much on kind of the people management side, but at the end of the day, a great VP of sales or great sales directors will help with that. What you really want to understand from kind of at least my perspective, the founder perspective, are kind of the cost drivers and what your business needs from a capital standpoint in order to scale. So.
Yep. And I think if we can revisit kind of the MRR movements graph, because it is an interesting one that really provides some granular detail as to your monthly revenue number. Nick, can you kind of walk us through what's going on there and
Sure.
how you think about that and what maybe you can glean from it?
So yeah, the MRR move, it's definitely one of my favorite graphs. So I look at this one every day. So that just seeing MRR by itself is fine. It's as long as things aren't going really badly, it should be going up and to the right. But that doesn't really tell you too much about the dynamics of your business. I mean, with this graph on the left, it's segmented by plan. So it's telling you the enterprise plan is contributing, the majority of your revenue, but it's not really telling you so much. Whereas the MRR movements graph, it's just telling you what's changed in that month as far as your MRR is concerned. And it's works best when it's broken out by, above the baseline, you have the new business, and layered on top of that, you have the expansion MRR and what's happening there. And below the baseline, you have the churn MRR. And here we see it's going up and to the right, which basically is extremely healthy in terms of the new business and expansion, because what that means is you're having sort of exponential growth. And it's sort of somewhat obvious, but it's worth kind of just internalizing the fact that if these bars are the same size, the same height every month over month, it basically means you have linear revenue growth, and your percentage revenue growth will be decaying over time. So you have to, if you want to experience any kind of exponential growth, and for it not to take you 100 years to get to 100 million run rate or something like that, you have to be making these driving these green bars higher month over month or quarter over quarter, and of course controlling the churn as well. But more interesting to me is the top of the new business and the expansion, which so and the net new is just the kind of difference between the two. It's just offsetting the thing, so it just kind of shows you the trend line.
Mm-hmm. Great, thank you for that. And I think you may know a thing or two about a product that can probably help you track some of this stuff outside of a spreadsheet. So encourage folks to check it out. And let's see, we've only got a few minutes left, but I think there's a good question here asking, how can we use this model for fundraising and figuring out how much to fundraise? We haven't really touched on that in this conversation yet. So Christoph, Matt, whomever wants to kind of touch on it, we can do it in the context of this graph as well as the bank balance graph. So I don't know if you guys have thoughts to share on that.
Yeah, sure. I think the model should give you a pretty good idea of how much cash you need over a certain period of time. Obviously, it's only as good as your assumptions. So if your assumptions are completely off, and if you expect that you just grow super fast without having to spend anything on sales and marketing, then the model will most likely give you a very inaccurate result. So in the end, the assumptions are critical, and as one or some of you pointed out previously, the model is also highly sensitive to some of these assumptions because of the compound and cumulative effects of some of these. But I think, as I said in the very beginning, I think it's still a good starting point. So I think it forces you to ask yourself the right questions, and then you will hopefully come up with decent answers, and in the end come up with a good approximation of how much capital you need to survive a certain period of time and to hopefully reach or get close to your goals. And for the purpose of like fundraising, since you asked about that, Brian, like also maybe in the context of like talking to investors, I think it helps if you as a founder can have a plan like this, and if any VC that you're talking to sees that you've at least thought through this very carefully, even though everybody of course knows that there is a ton of uncertainty involved. But I think it's at the minimum it's a good basis to discuss your funding needs with any investor that you're talking to.
Yeah, I mean, I think that's the key, right? Investors want to see that you're thinking critically about the business. You have reasonable assumptions. This model gives you that tool to go in and have that conversation. I just noticed one question here that I totally meant to address and I forgot, which is the bigger the deal size, the chunkier the revenue growth will be. It's just the nature of closing bigger deals. It's going to be a little bit lumpy, right? So you're going to have a great month, you have a little bit slower month, have a really good month, have a little bit slower month. My only recommendation there is model smoothly, right? Because you can't really estimate exactly how those fall into months. Just, get to your right kind of growth decay, model that out. And then when you're like looking back and measuring the business, like group that into quarterly performance or biannual performance and measure against that, because especially with the bigger deals, like that lumpiness is definitely a factor. But what you want to do is abstract it up one level to either quarterly or biannually or annually in many cases. And that'll help kind of smooth it out so you can understand, hey, am I on track or not?
All right. We got a whole minute to spare here. So I think thanks everyone for participating. I think it's been very helpful content for myself, certainly, and we're happy to I think follow up if should anyone have any questions. I know we tried to touch on a lot of stuff here and unfortunately couldn't cover it all, but as we mentioned, we'll send you guys the deck along with the recording after the webinar. And big thanks to Christoph, Matt, and Nick for you guys' time and sharing your experiences with us here.
Yeah, thank you, Brian.
Thank you, Brian.
Pleasure. Thanks, everybody.
Okay, thanks, everybody.
Thanks all.
Right. Bye-bye.